Hello and welcome back to another video in this Principles of Finance series. Now we're going to speak about bonds and their valuation. Now that we've kind of gotten down the fundamentals of time value of money and how annuity payments work and uneven cash flows work, luckily bond is an even cash flow. But first things first, let's try and understand, what is a bond and who issues bonds? Well, bonds are really one of the most important securities. If you skim through the Wall Street Journal, you'll see references to a very wide variety of bonds, and the variety, at times might seem confusing, but in actuality only a few characteristics distinguish the various types of bonds, but bonds at large really act the same way. Now, essentially I think the textbook definition of a bond is just a long-term debt instrument. And who issues those bonds? Well, you have treasury bonds, your corporate bonds, municipal bonds, foreign bonds, just bonds that are either issued by the federal government or bonds that are issued by corporations, bonds that are issued by local and state governments, foreign bonds, bonds that are issued by other foreign governments or foreign corporations. Essentially, they all do the same thing. They're a long-term debt instrument. It's a way for the issuer to raise money. They are essentially selling you a bond. You are purchasing the bond. So for this chapter, I think even for the time value of money, we should always kind of be thinking about the effect of the bond or the profit that can be made on the bond from the investor's perspective. Later on, when we get to capital budgeting, we're going to flip around to the side of the corporation or the government and understand how much it costs them to issue bonds. But right now, we're thinking about investing in bonds. What's a good bang for our buck? Now, at this point, I'd just like to clarify, the difference between a bond and a stock, because they are two types of securities, and obviously they are completely different. But it would be a terrible thing if people would get confused. So let's just try and understand there's a huge split between the way that corporations raise money through bonds and the way that they raise money through stocks. Now, the idea over here is that let's just write down capital raising, even, because this is a way of raising capital. Essentially, the reason why we have the stock market, the reason why we have investments is essentially because we're putting away money today so that we can have more money tomorrow. So capital raising, essentially, the whole idea of finance is not just greed, which it is a lot of the time, but that's a different matter. The whole idea is that the corporation or the government might need money today, but they don't have money today. And there are very wealthy people who do have money today that don't need that money today. So there we have a little market. If you've done economics, you could call it the money market, and you call the demand for funds and the supply for funds, and that actually determines the interest rate. This is the quantity of money, just the quantity of money, and that would be the Q star and the I star, which are the equilibrium interest rates and equilibrium supplies and demand for money on the money market. So, this is also P, if you remember, because essentially the price of money is the interest rate. It is the price of holding money. It's the price of holding money, it's the price of not holding, it's the opportunity cost of not holding money. So essentially, this capital raising process is divided into two different, very distinct splits. Capital raising can either be achieved through debt, or it can be achieved through equity. And this is something that you should always remember. There is a huge gulf between these two types. Namely, debt is a debt instrument. This is where a company is actually borrowing money from you. And equity is when a company, for example, is issuing common stock, which is where they are actually saying, here is a small percentage of everything about our company, but we're kind of low on cash today, so could you give us some cash, and we will give you a small percentage of our company, and trust us, with your cash we will grow our company much bigger, and therefore the value of our shares will increase. And so therefore, by holding that small percentage of our company, i.e. in the form of common stock, you will actually see great returns. The way that they incentivize debt investors is by saying, well, if you give us a principal amount today, we will make sure to return that principal amount to you in the future. But because debt will act as a fixed income security, it's called fixed income because it will give you a fixed stream of income as an investor in the form of principal payments. So let's think about debt. There's there's really two splits. You can, you know, if a company is raising capital through debt, they can either go to the bank and just say, listen, we need some cash, and the bank, you know, can lend money to the company, or the government, you know, or the government, and then the other way is bonds, which is what we're dealing with. That's, you know, that's the topic of the day. Now, equity, on the other hand, we usually think about in three different splits. Well, usually two: common stock and preferred stock. But let's also just, you know, for the sake of being precise and accurate, let's just have a retained earnings here too. That's just kind of when you know, the company have finished off checking all their financial statements and they get to their net income. They can usually distribute money back to their investors through what we call dividends, or they can retain their earnings and loop them back into the top line, where they begin their organic business processes again, and they use those retained earnings, for example, for research and development. How can we organically grow our business through developing or researching new ways to carry out our business more efficiently and more profitably? We can, you know, slash costs, or we can benefit from economies of scale, etc., etc. Preferred stock is kind of a hybrid. It's a little bit more complicated than a common stock, but it's kind of a hybrid between a debt and an equity. We don't really need to deal with that at length right now. And common stock is basically the stock that you see on the stock market. When people speak about, oh, did you see Apple's stock and what it did yesterday? Well, they're really speaking about Apple's common stock, which is essentially the most basic type of stock, where the company have essentially given you a percentage of their company and promised that with that money that they take for this percentage of the company, they will grow their business, and you will see profitability in the way of capital gains, and perhaps even dividend yield if they pay out a dividend, which it happens to be Apple did start doing. But many companies don't pay dividends, and they say, well, we won't pay you a dividend now, but if you trust us, we'll take the money that we're producing and we'll loop it back into retained earnings, and we promise that way that the common stock's value will increase through earnings per share. But that's already a little more advanced. The topic of the day is bonds, so just wanted to discuss that a little bit, just to kind of draw the line between different types of raising capital. Bonds is what we're going to deal with today, because it kind of touches on these new concepts that we've just been speaking about in terms of time value of money. So let's think a little about the key characteristics of bonds. You know, they have some common characteristics with the different types of bonds, but they do have different contractual features. For example, let's just write down, you know, to begin with, let's just write down, let's say, treasury bonds, treasury, corporate. Don't worry, we'll get to the math later. It's just important to know this stuff early on, because it makes a lot more sense logically. Municipal and foreign. So, you know, we mentioned these before. Just want to have them written down if you are taking notes, just to know that these are the types of bonds that exist. You know, so speaking of contractual features, we're just going to focus on I guess for now, corporate bonds and treasury bonds, municipal bonds. Foreign bonds obviously have different kind of you know, different contractual agreements, because obviously foreign governments have different, you know, tax rates, and you know, they obviously are subject to a different domestic you know, money market, so their interest rates are probably wildly different. Also, obviously, they're denominated in different denominations simply because of, you know, floating currency exchange rates, etc., etc. So we're going to focus on domestic, you know, treasury, municipal, and corporate bonds for now. So most corporate bonds, for example, have this feature, a certain feature, and this is going to be very important because I think it's one of the only kind of exotic features of bonds that are dealt with in principles of finance. But they're called call features, and if you've been to class, you've probably heard about callable bonds or bonds with call features. And these call features are basically features embedded into the bond, the bond indenture, it's called, which is where all the covenants are kind of described. So even though the call provisions can vary widely among different bonds, a lot of corporate bonds have these provisions for early repayment, which is kind of where, you know, the company give you this 10-year bond, but then after 5 years they kind of call it back. get to that a little bit more, once we discuss the principles of bonds and how they kind of work, we can kind of get a little bit more specific about these exotic features that are applicable to certain bonds. Some bonds are, there are debenture bonds, there are subordinated debenture bonds. Some bonds are backed by specific assets that need to be turned over to the bondholders should the issuer default on its principal payments. Other bonds, subordinated debentures, for example, they have no such collateral backup. And so, this is the nature of bonds in terms of their exotic, specific features. But let's kind of get into the nitty-gritty of how bonds are evaluated and which metrics are most important for calculating bonds. So let's kind of scoot down here. Actually, maybe we'll do this in a part 2. So thanks for watching.